So why is IV important to overnight swing traders? IV means implied volatility, and it's an important metric when we're considering how we're going to trade our options overnight, no matter what ETF or stock you're using. When trading options, we do want volatility because that's how we make most of our money. We don't make as much money during flat markets. We can even lose money in flat markets even when our indicators are correct. Although you can trade any stock, ETF, leveraged ETF, or options overnight, I generally trade options like the SPY, QQQ, and IWM. The QQQ and IWM tend to have higher IVs, higher volatility than the SPY. So when the market has low volatility, I tend to shy away from SPY, although my algorithm is based off of SPY. There are a number of things to be concerned about when you see a lot of movement in the IV, and I'll talk about that in a moment. But there is a sweet spot as to where I like to find my implied volatility, and it's generally between 20 and 30. When I see IV below 20, I'm a little more cautious. It's a little flatter market. But when I see a stock or ETF in the range of 20 to 30, I feel like I have a good opportunity to make some money. The general rule is if your stock or ETF or the market in general is going up, the volatility is going down, so your IV is going down. However, if your stock or the market is going down, well, then your IV is probably going up. If your IV goes up really fast, especially to extremes, that also means it could come down really fast if the market turns around. And that could bring the premiums down at a very fast rate, resulting in what we refer to as an IV crush. This is why we often play it more conservative during high volatility times. Yes, there's great opportunity to make more money, but there's also great opportunity to lose more money. So we may consider smaller directional plays, or if we want to play it safe, we might have a 2-to-1 options ratio versus maybe a 3 or 4-to-1 options ratio, but again, in a much smaller position size. If activity and volatility settles down and the IV of your stock or ETF goes below 20, you might want to reconsider what type of ratio trade you're making, especially if you've been making more conservative ratio trades. Because ratio trades such as 2-to-1 actually don't work very well once the IV is below 20. So you'll want to kick it up a notch to maybe 3 or 4-to-1. One of the rules I've used in the past, and I think it's still relevant today, is the $1,000 rule. And that is when I look at the SPY options about 4 days out. And if a straddle or a SPY TS trade, if you look up that old style trade, which is basically a call in the money or put just in the money, and then a call or a put just one step out of the money. If that total premium equals $1,000 or more, you just may want to rethink your trade. I have a video on that from a couple years ago. It's called the $1,000 rule. And generally, the solution to that is a very, very small directional trade if you want to trade at all. Because even if the directional trade is correct, again, it could still lose money because of the IV crush. So always keep an eye on your stock or ETF's IV. If it's getting too high for comfort or too low to make any consistent money, you might want to look for a different stock or ETF to trade, even if it's just temporary. IV can be the options overnight swing trader's best friend. It can also be your worst enemy. But knowing how to play IV can make you a winner. I'll see you in the next video.